let's start it. Let's go for economic calendar first, and let's have a look on what we actually going to be looking at during this week. All right, so this week, Tuesday, I've just, oops, sorry, let me put median here as well. Look, let's not waste time looking at low volatility events. Not because they are not tradable, they are tradable. Don't get me wrong, they always been tradable, but the thing is, it's much better for us to look at the bigger picture and look at what actually matters for the market at this moment and not small picture. So German retail sales, it was Monday. What? Okay. It's strange. Anyways. Yeah, so yesterday we didn't have much. Consumer credit came lower. Actually didn't affect much the pound. Sorry, it did affect much the pound, but that was pretty much it. So Tuesday today, we already had France GDP that was better than expected. Was expected to grow 0.2%, but it grew 0.3%, so 0.1% higher than expected. This, yes, is fulfilling a little move on euro dollar. Okay, so if we look at euro dollar, it is trying to push and it is trying to break. Oh, actually, yeah, it is trying to break this level of 82.58, 1082.58, just right there. All right, so if we break this level, it's going to be very good. Most probably we can come back around this area here, and then if we break this area, we come back on this area. But first, let's have a look. We're gonna have Germany GDP growth rate quarter over quarter, but that's the flash. All right, so we don't care much about flash. Yes, it does have an impact on the market as well because it's a normal data as any other, but it's a flash data, so that doesn't impact much as a finer data would. Okay. I only look to final data. But yeah, of course, we're going to be paying attention on that. Italy GDP as well, Euro Area GDP, and Germany inflation rate, okay, year over year. So if we look here, very concise, let me put in a black color. So Germany GDP from here all the way down to here. Okay, we're looking at massive data for Europe, right? From 6, 7, and 10. This is all Australia time, okay? AU time. All right, so Australia time. We're expecting a bit of a retraction for the quarter over quarter GDP from Germany, and we're expecting a bit of a better increase, but still break even for the German GDP. All right. After that, we're going to have, look, I'm not caring too much about Italy. I'm caring more about German, as it is a big producer for the Euro area, for the Eurozone. And of course, I'm caring about the Euro area, all right, for the whole Euro area. That includes German, if I'm not wrong. So yeah, expecting GDP to be better than the previous from the year over year, but a retraction on the quarter over quarter. So this one is not too important. Okay. Oops, sorry. This one here is not too important, so we don't need to care much about this part. But we do have to care about the growth, the GDP quarter over quarter and year over year. So 0.3% was the previous quarter, and now expecting 0.2%. And the GDP growth rate now year over year is expected to be 0.6 from 0.4. So my honest opinion is that yes, we may see some pullback on the euro dollar. Okay, coming back from, as I've just said, a breakthrough this level. Maybe not even retest, just continue to go around the levels of 83, even 85. Okay, I do believe on an 85 area. From the past week, on the very end of the week, we did had a pretty much of, yes, a consolidation market. Some people may call this as a flag or whatever they want to call it. But I do think that this is just another consolidation phase, and that people can give like fancy names to consolidation. That's my opinion on that. No judges, all right? No judging anyone. Okay, so now then we go to 10 p.m. Germany inflation rate month over month and German inflation rate year over year. Year over year expected to be no changes, but the month over month is expected to grow a little bit. Look, to be very honest, if we see these this tree, better than expected. German GDP growth year over year, GDP growth for Euro area year over year, and German inflation month over month. We can, if all of those three have a better than expected area, then yes, we may see euro dollar going up. Okay, euro dollar going up. This is my honest opinion, what I think it can possibly happen. All right. Now, the reasons are, if we still have a better economy in this situation and the market are priced in a worse than expected from the previous, investors will look to this as a positive outcome for the country. Therefore, the only thing that we'll have to judge is the ECB, right? ECB will take this data and look at it and say, look, there's still room for us to hold, or we still have possibility to another cut. I mean, my honest opinion is that the ECB is doing a good job on maintaining the target and unchanged. And they have to look at some things, all right? And these things are, the first one is the CPI, of course, the inflation. But just underneath the CPI, we need to look to the PPI as well. The producer price index is the inflation for the producer, all right? So the CPI is the consumer, all right? So us here, and then these are business. Okay, these are for business, and we have and we have as well the second one, and it is the GDP, and the third one is the labor market. Well, actually, the second one would be labor market. Okay, and then the third one would be the GDP. Now, they have to make all of these work together to not have any damage into the economy. Don't get me wrong, but this is very hard to do, okay? Because sometimes when the CPI is when the CPI is lower, we may think that, oh, all right, that's pretty good. But the data that they actually have to pay attention is the core CPI. Does anyone know why is that? The reason is kind of simple, okay? Because people may believe, okay, look, the central bank has to look only for the CPI, or the central bank has to look for only PPI, or only labor market, or only GDP. No, the central bank has to always look for the core PPI, the core CPI. Any core value is the same as the core PPI. So the reason behind this is when we have a CPI, we have items that monetary policy can't control. Okay, when I talk about monetary policy, I mean interest rates decisions, quantitative tightening, quantitative easing, open market operations, and treasury bonds yields, buying, purchases, and so on. So they can't control some of the things of the economy, like energy prices, food prices, right? They're not God to make it rain or to make stop raining, so then we can have a nice carrot on the table on the dinner. Right? They can't do that, but they can increase the rates. If they increase the rates, they can stop population to spend. If the population stops spending, then yes, we may control inflation through hiking the rates, but not making raining. All right. So that some things that the central bank can't control. So to actually take advantage of the monetary tools that the central bank can use, can apply into the economy, it's very simple. Look to the core CPI. The core CPI is declining. That congratulations, you're doing a fantastic job. Otherwise, keep doing what you're doing because you need to improve certain points into the economy. Then we go to the PPI. If the CPI is lower, the core CPI is lower, we need to understand that, yes, for the consumer price index is lower, but is the producer as well getting lower inflation, or is still passing to the end of the consumer? So this is a very typical question when we go to, let's say, ECB, Fed, Bank of Japan, not Bank of Japan, Bank of Canada, RBNA, RBNZ, RBA, RBNZ. These are typical questions that journalists asks, the chair. And okay, we've seen a decrease, we've seen a contraction on the CPI. Will the PPI contract as well, or we can see a growth on the PPI? The reason why they ask this is if the CPI is decreasing, yes, that's fantastically good. The core CPI is decreasing as well. That's fantastically very, very welcoming to the monetary policy. But if the PPI continues to expand into certain paces that are uncontrollable, then soon or not, the PPI will pass through the CPI. And if we get a higher reading on the PPI, right? Let's say it was expected to be 2, it comes in at 2.5. This 0.5% higher than the consensus is expecting may how can I say that? It may, what's the actual word? May spill on the CPI in a 3 to 6 month horizon. All right. So just bear in mind, consumers are not, producers are not dumb. And if I'm producing, like, let's say, what do I have here? I'm producing pens, right? This pen costs me $1 to make it, but then the raw material is inflationary. So therefore, I need to account for inflation on this raw product. And now it's 12 cents to produce. So I'm going to have to calculate my new margin to generate my revenue through my sales points. And my sales can be done through B2B, B2C, right? And B2B2C, and so on. So it's tough to measure inflation on a certain reading, just like, oh yeah, CPI is going down, it's good, perfect. No, now we have to put this in context, right? So that's the first thing that the central bank has to do. Second is look at the labor market. What I mean by labor market is labor market heating up? Is labor market getting lower? Okay, because labor market will define if population can spend or if population can't spend, and if we're going to have a crisis or not. This is not any seven-head monster to solve the problem. If population don't have money, therefore they can't spend, and if they can't spend, then the business will get no revenue generating and so on. So we always need to think about, okay, if the labor market is kept strong, because this is the dual mandate of the central banks. Most of the central banks, on the G10 economy, I don't want to say, like, for instance, Venezuela or Colombia or any like those countries. Argentina, it used to be, especially those socialist countries where they have a central bank very like out of the curve, I would say, that they do whatever the master asks them to do. This is very bad. But anyways, not here to talk about politics. So if we have a stronger labor market for a certain period of time, then yes, this is fantastically good for the economy, as we know that the dual mandate is being achieved. The dual mandate of the central banks that usually maintain a stable labor market plus bring inflation down with no residual with no residual on the economy. All right. So that means don't spill any problems on the economy, like a spiral credit or any sort of thing. Yeah, this would be a two most big things on the economy. And then we have GDP. If labor market are producing, then the gross domestic product will grow naturally. Okay. The GDP can be affected through CPI. Yes, it can, but it's weighted differently. Okay, but it's another math calculus that we go. We don't need to discuss that now, but just so you know, these are the three most important things to be looking at right now on this phase of the market. Okay, at least in my opinion. Is everyone good? Let me just drink some water. Okay. So that being said, let's move on. Let me delete all of this drawing. Okay, so this is it for today. Tomorrow, Wednesday, George job openings for USA. There you go. Australian monthly CPI indicated. Australian inflation rate year over year, quarter over quarter. Then manufacturing PMI. Japan consumer confidence. That's going to be very important. It's expected to grow 0.1 from the previous reading, 36.4 now to 36.5. Moving on, France inflation rate. That doesn't look too good here. There we go. So that's the big one for Wednesday. Yeah, that's going to be the big one for Wednesday, as well as the monthly indicated CPI for Australia. So that's tomorrow. Your thoughts on USD JPY? We're going to get there. I'm just going to go run through the economic calendar first, so everyone knows what to expect during the week. And then we're going to go and look to some pairs. Yes. All right. So where am I? There we go. Euro area inflation rate year over year flash July expected to retract a little bit from 2.5% to 2.4%. I don't expect that. I do expect that inflation can, it's too soon to say. I need to see how the GDP will perform. But most probably we can see that inflation won't retrace on Europe, all right? We may continue to have a decline on euro dollar. I'm not saying about these, okay? Because my main target was in 108 that let's call it. All right. It was 108.01. I mean, let's call this my TP. So I'm expecting now a little pullback to 85 most probably, and then we can continue to go lower. But this data will fulfill the move for a stronger euro this week. All right. Okay. Moving on. On Thursday, we have the Fed, right? Interest rates decision, very important. I'm going to talk about that in a minute. And then the Bank of England interest rates decision as well. Expected to cut 25 basis point, widely expected already. And then the ISM manufacturing prices, the unemployment rate, and non-farm payroll on Friday. All right. So let's talk about the Fed first here, all right? Fed interest rates decision, and this, of course, will lead it up to your question, Augustine, on the USD JPY, okay? Because we do have the base as US dollar, so it's very important to know what's going on with the monetary policy from each, currency country. So let's have a look first at this tool. Let me log in here on my terminal, just a second. All right, it's just logging in. All right, cool. All right, so let's talk about the Fed first. Let me get my pen. Perfecto. All right. Okay, so let's talk about the Fed here, Federal Reserve Bank. The next expected move is to hold. All right. So we are expecting no changes on the monetary policy from the Fed. The probability of this happening is the hold happening is 96%. All right, so that's a very high probability. The current rate is 5.37.5, so 5.375. And the change is going to be, it's going to be 0%. And the next meeting is on the 31st, that is on tomorrow. Now, a week ago, this was the expectations for the Fed, and a cut to begin on 32. Let me check. The first cut to begin on the month of September. All right. And this is a probability of, check. Yeah, the 18 of September. All right. Expected to be a 25 base points cut. And then after that, on November, expected to have another 25 basis point cut. And then after that, on December, expected to have another 25, and then another 25 on January 2025. And then March, another cut, 25 base points. And then on April, another cut. And then on June, another cut. I don't believe that this can possibly happen with the market, okay? Because we are seeing some higher CPI numbers, okay, for the USA, and this may spill into the retail sales. All right. So my honest opinion about this is, yes, we may expect one cut this year, and I've been always saying since the beginning of this, 2024, people were like, yeah, but we can expect 6-7 cuts from the Fed. Last year, yes, I were believing on a 7-cut, monetary policy. Very, very dovish. 2024, dollar would run very hawkish, very bullish on the first half of the year. We go into the second half of the year. I thought the dollar would lose some strength, but apparently, no. Apparently, no. Apparently, the US dollar is alive, still alive, and breathing. All right, so we may see more and more of this current scenario into the market. Okay, and now if we look for the expectations for the current, it haven't been changed much. All right, only the final on the very end here, they've changed from 398 a week ago to 387 now. So not much changes here. To be honest with you all, these are the current, and this is a week ago. So no, nothing too crazy here. All right. Now, again, no one is expecting cuts for the next move, and everyone's expecting a hold. This is from Prime Market Temno. It's a private tool, subscription tool. But if you look at the public tool from CME Group, I just loaded 95.9% of the market is expecting no changes. Another pause, cheeky pause here, and then a pause here as well. Okay. Okay. So that being said, what will matter then for the actual Federal Reserve, right? Because okay, so if they're gonna pause or whatever, so what's gonna happen, right? What's gonna happen with the US dollar? All right, my honest opinion, my simple reaction for you this question would be, it may be strengthening. All right. There are some things behind this, but let's go in parts. All right. So first one is when we have the meeting when we have the rate decision, the market is already priced in. The only thing that can possibly happen to shake the market on the rate decision is something that is not expected. If something gets to the market that it's not expected, then yes, the market will feel it, and it will feel it a lot. All right. It may be a cut that no one is pricing, but this is why it's going to be important to judge the NFP, all right, on Friday, because if the NFP comes higher than expected or the revised up numbers or whatever, then that's going to show to us. I don't think the NFP will come higher. I think NFP will come lower, but that's another conversation. It's going to show to us that pretty much there are chances of the Fed no cuts. Sorry, I didn't have a good sleep tonight. So there are chances for the Fed to don't cut into 2024. Now, putting all this in context, right? We are decreasing on inflation. We still have inflation up at the target. Labor market, yeah, it's like yes and no. It's like a negations. It's much more into no than yes, because inflation is too high. Prices of living costs are increasingly high. So not a good economy to to have your money there, I think, to live there, let's say, but it's still a good economy to put your money because there's 5.37% of interest rates, so it's not bad, paying a good cash rate, eh? All right, so that being said, what will matter for the market most is what Jerome Powell will say. This is what will matter for the market the most. Right? It doesn't matter that rates decision. We already know the rate decision is a pause. If they come here and do something different, then yes, we may have a big change of character on the market. Okay, but for now, the market is really priced in. All right, next. So that being said, here, federal interest rates decision, we're going to go for oh, wait a minute. Where is Bank of Japan? Oh, there you go. I've jumped it. Sorry. Okay. Bank of Japan interest rates decision. All right. That's a cheeky one. Okay. So answering the question of USD JPY now, where is USD JPY heading? So if we look to USD JPY at this moment, no, the BOJ will, Bank of Japan, oh yeah, the BOJ will hike rates, most probably, yes. All right, so this is a 4-hour chart, okay. I do believe that we can still have room to come back to the levels of 151,500. 151,500 around these levels here, 151,400. Can I correct this? 151,400, 151,500. All right, perfect. These are my target, this area here, all right? This whole area here is my target, all right? So pretty much this is what I'm expecting for USD JPY. But now talking about the Bank of Japan. Bank of Japan, right? 60% of the market is expecting a hike, right? And expecting a 10 basis point hike. So a very cheeky one here, because if we look at the expectations are continually increasing. A week ago, people were believing on a hike, and now they are believing on a much more steeper curve on the hike process. Okay, so let's have a look here. So the current right now is at 0.14. So they were expecting 0.12. And then they go for 0.18 to 0.19. And then 22 to 26. And that will result in 0.29, 0.3. So that will result on pretty much 0.01% difference from the beginning of the rate increase season to the end of the rate increase season. That's not a big difference, but to cover the actual curve, right? This Mayo curve. I don't know if you guys have heard about this Mayo curve. There we go. Let's go this one here. It's not about global competition or whatever you see here, right? But it's just to cover the curve, this is the point of a 0.01% difference. But they have to go from here to here. So it gets wider and wider, and then it synchronizes to there, all right? So that's pretty much what I'm saying. It's going to be like a U-shape, a Mayo-shape curve, all right? So, yeah, most probably they can hike. All right, most probably they can hike. This will make Japanese yen stronger. I wouldn't trade USD JPY. I would like to trade, let's say, Euro JPY, that it's much more weaker than the actual US dollar, right? US dollar can still have potential strength, especially because we have the NFP, and NFP can come higher, and that was going to be a disaster for trading, all right? So protecting your capital, I would go for Euro JPY than USD JPY. But this is just my personal opinion. This is just my take. If your trade strategy is on US dollar JPY, then yeah, USD JPY, you go. Not a problem at all as well. All right. Okay. So this is the Bank of Japan. Why do I think they can potentially can increase the rates? All right. First of all, inflation. All right. So if we look to Japan inflation, we can see that the inflation rate is going higher. All right. So we went from the beginning of the year to 2.2%. All right. So we were decreasing. All right. We're decreasing from 3.3 all the way to 2.2. Now we're increasing to 2.8, 2.7, and now 2.8 again. So I do believe that the inflation rate is on a good peak. All right. Around 3% would be best, would be the best. So let me just core inflation. There we go. Okay. So the core inflation is rising. All right, it's still raising 2.6 now. It was 2.8. So the core inflation is rising. Remember what I've said on the beginning of this call. So yes, if inflation is rising, then most probably, all right, let's have a look at the GDP. There we go. You can see the GDP is not that good. This is 2022, 2022. Oh, this is the year over year. There we go. All right. Yeah, we can see definitely it's not like a very good GDP from 0% on Q4 2023 to negative 0.5% Q1 2024. So I understand now why 60%, only 9% is expecting more to happen than the actual other 40. So it's a tricky one. It's a little tricky situation for the Bodge. I completely agree with you, Lawrence. My honest opinion is that if it happens, it wasn't a surprise. The market will react very strong, but it wasn't a surprise. Those sort of events, they're very risky events, very risk-driving events. I highly don't trade those events, and like it's unreliable. All right. Whatever they say, they do the opposite. So it's very hard to know. But that's my take. All right. This is pretty much my opinion on the Bank of Japan. All right. Next one. Bank of Interest, Bank of England. Let's have a look on Bank of BOE. Bank of England, there we go. Yeah, again, 0.8, expect more. You know, this is the only difference. We can't look at the 58. 8% of the market is expecting a cut. I would prefer, you know, 70, 75% than the actually 58, but I think it's very well priced in already for the Bank of England. And look, if we look to England inflation, we are very good on UK inflation. Okay, we are under the target. We are at 2%. The consensus was 1.9, but the previous 2% as well. So we came all the way up from 6.8% a year ago, and now we are at 2%. So that's a round of applause for the Bank of England. They've done a pretty good job on maintaining the rates for longer, hiking first. They've done a good job. Can't complain. The pound is not doing that well, as I've mentioned as well on last Tuesday. I was looking to trade short on the GBP USD. You know, ended up to being a good trade. Nearly hitting the target here at 28. There you go, 28 here. Not in the target specifically yet, but then most probably we can come down to here to 26,600 with this cut on the rates. Okay. I think it's due. I think it's more than time to cut the rates here on Bank of England. I think it's going to be a well done decision from them. You know, it's just need to know how they will approach now this scenario where they have controlled inflation, but still it's a very tricky time. If they've done one something little thing wrong, it's gonna go back up again and it's gonna be a disaster. Okay, so you don't want inflation to go higher again when you already brought this down. 50-50 scenario here for Boyer, more or less here, 4 to 5 hawkish cut. Yeah, around that. Yeah, if it cuts, it's like one or two people, all right? So it's gonna be very, very, very tricky one. Very tricky one. Very strictly. All right. Now, anything else? NFP. Non-farmer payroll. I'm expecting it to be lower than what is, all right, lower than what it is. NFP is never on what the consensus say. NFP's consensus is 175,000 now. Unemployment rate is 4.1%. I do believe on a decrease of let me just drink some water here again, guys. All right. Yeah, wow. Speaking 1 hour straight, it does hurt a little bit, as I was saying. So so I'm expecting a decrease on the United States employment rate, so that's pretty good for them. Just joining, I'm not sure if you talk about NZDS yet. No, not talking about New Zealand dollar today, but just talking about the economic calendar for now. So, as I was saying, so the NFP is pretty much, but if you have any questions about the New Zealand dollar, just send it through and I will have a look for you, Thomas. So for the United States NFP, I do believe it can come lower. But then the unemployment rate, I believe that it can come lower as well. So higher, but it can come lower. Okay, so in my opinion, it will be a decisive approach to the Fed. All right. When the Fed look at the NFP for this month of July, this will lead to either they cutting 3 times or 1 time. Okay, because don't get me wrong, we only have 4 months left of the year. All right, so we are going to August, November. Sorry, I'm crazy. Just a second. So we are going to August. You're gonna get September, October, November, and December. All right, so December, November, October, and September, and actually August. So pretty much 5 months. All right, so because we're not it yet. So in 5 months we're gonna end the year, and they're expecting 5 months. Actually 4, because we don't have a meeting in the August, so only 4 meetings left, expecting 25, 25, 25, 25. So that this is a 1% from 5.30 to 4.30. All right, I don't expect that. I do believe that we may get to 5 or maybe 470, 480, but not 4.3. All right, this is too much for the Fed. They're not ready to do that yet. All right, guys, this is my take for today. Hope everyone helped. I could help someone here. I will be here again on Thursday from 8 to 9 p.m. Trade safe, use risk management, and I see you next Thursday. All right, guys, and next Tuesday as well. Thanks, everyone. Have a good, great week ahead, and talk to you soon. Bye-bye.